Make sure you do not sell another buy-to-let property until you watch this video. In this video, I'm going to tell you 7 good reasons, well actually 7 shockingly poor reasons why buy-to-let property investors pay far too much capital gains tax when they sell their property investment. That's right, I'm going to share with you some of our own experiences of why buy-to-let property investors, just like yourself, who are thinking about selling a property, will end up paying more CGT than they should be. And I estimate that 90% of landlords out there in the UK are paying far too much tax anyway, especially CGT, which I feel is optional. There are ways of circumnavigating CGT so you don't need to pay that tax ever again. Before I go into this, let's understand what capital gains tax is. Capital gains tax is the sales price less the purchase price of the property, less any capital items that you've expensed. That gives you then the capital gain, which is then subject to capital gains tax. You do have an annual CGT allowance as well, which will further decrease your taxable gain, which, as you can see on the screen. Oh, and by the way, already I must have to say to you that we've already recorded a video of how you can mitigate CGT, so make sure you watch this video. So not keeping receipts is the very first reason why people pay far too much CGT, and it's not even a laughing matter. Because ultimately the CGT, as we described earlier, is the sales price less the purchase price less any capitalised items. Now if you have not got the receipts that justify why you've got an SDLT liability on the purchase, you've got the enhanced capital cost, so if you had an extension done on the property, let's say for £20,000, which could reduce your CGT, well, if you can't see that receipt or you can't find it anywhere, and the builder that you did the work for you has now disappeared, then unfortunately you will not be able to claim that £20,000 worth of cost to reduce your capital gains tax liability. So it is a lost opportunity. So that's reason number 1. The second reason is your accountant. Yes, your accountant. When you do your self-assessment tax return, here's a question for you. Do you review the work done by your accountant when they're submitting your self-assessment for you? In fact, let me just ask that question for you, and please answer that question inside the comments box below this video. Do you review what your accountant has done on your self-assessment? I reckon you should do, because I think there are a number of mistakes that may be made either on your side or indeed the accountant's side, because there's not enough review process being done. I think what happens in reality is that people want to rush over the line to get their tax return done. And I can understand that, but unfortunately, it does mean that you will pay more tax than you should do. So please do, as a side issue here, do your review with your accountant as much as you can. So as you mentioned before, you've got this enhanced capitalised cost. Now if your accountant in question has seen items such as double glazed windows, or they've seen some kitchens, and they've interpreted that as a capital cost because you and they have not had a decent conversation, they would then capitalise those items and then move them out of your tax return, which basically means that you lose the right to claim those costs against your property income, which means you pay more income tax. Well, the bigger danger here is that you or the accountant then forgets to add those costs as a capital item. Now, one thing I would say to you is, if you see on this screen here, you can see that there's a balance sheet. I've just used the QuickBooks version for this, but a balance sheet allows you to move costs from your income, profit and loss, to your balance sheet. Now, if you're using a spreadsheet, it's highly unlikely that you or the accountant in question will move that cost from the profit and loss to the balance sheet. And that means, bam, you've paid too much income tax, potentially, because that could have been claimed for, and you've paid more capital gains tax because that cost has just disappeared. Ooh. So ultimately, where has that cost gone? It's just disappeared. It's not in your profit and loss where you can claim the income tax, and you've not got it in your balance sheet because it's just been deleted, so you pay more CGT as well. So that's another reason why you may end up paying more CGT, because you and the accountant have not kept a close eye on the movement of money from profit and loss to your balance sheet. It is negated, it's deleted as a cost, and therefore you never claim the tax relief that you're allowed to do. The third item is you forget. It happens. We've had client after client when we're talking about selling a property and we said, right, well, here is your purchase price, here's your capital items, but it looks quite low. Did you not do any work? You said that there was some work going on. Now, if you're not having that conversation with an accountant, it's easy for you to do your own self-assessment tax return and completely forget that you had an extension done or you had those windows put in the property and you didn't claim it against your income. And therefore it was a capital cost, but you didn't remember the receipt was even never there. So you've now got this, whatever, £5,000, let's say, of capital items that you've just forgotten about, and you've got this £5,000 that's missed, and ultimately, if you're a high rate taxpayer paying 28% tax, well, that's a lot more tax that you've just paid just because you have forgotten that that work was ever carried out at all. Oh my gosh. Here's the fourth reason why people pay too much CGT. Their spouse. You could have a husband and wife in a relationship. Well, I hope you're in a relationship anyway. But you could have a husband and wife, or a civil partnership, in fact. And you might have one person that has a property and they sell it. And if you've got one annual CGT allowance, then anything in excess of that CGT allowance will be subject to CGT, clearly. Now, why didn't they have their spouse, their civil partner, have part ownership of that property so that they could utilise both annual CGT allowances? Because we're talking right now that the CGT annual allowance is £12,000, that's £24,000. Now, if you're a high rate taxpayer, that's another £12,000 that you paid tax on, which you didn't need to do. So why did this happen? Well, the simple truth is, when you sold the property, you forgot, to transfer some of that property ownership to your spouse. And that means that you've lost the CGT annual allowance and you've paid too much CGT. So here's the fifth reason why people pay too much CGT, and that is splitting the ownership. We've already talked about the CGT allowance. So if you've got one person with a property ownership and you've got their spouse, their partner on the other side, that you can utilise CGT allowances. But this goes further than that, because you could have one person that's got a high rate tax band and the other person who's a basic rate taxpayer. So this person is going to pay 28% tax and this person is going to pay 18% CGT tax, which is a difference of 10%, you've guessed it. So, could you have allocated more of the property ownership to the basic rate taxpayer? The answer is correct. Yes, you can. And as a result of that, you could be saving yourself 10% tax just by moving the property over to one person to the other, as we've described in this example here. Okay, the sixth reason, and this is probably one of the most significant for me, is people are reactive in most times. So they've got these tax changes, section 24, they've got legislation changes, and the first reaction maybe is, well, let's just clear out our property portfolio and get rid of the noise. Well, Yes and no. What I would be suggesting to you is phasing your property sales over time. And the reason for that is because it does allow you to use your CGT annual allowances. So if you've got 4, 5, 6 properties, why not sell 1 or 2 of them in batches in each tax year? Which means that you get, especially as we described earlier, that you've got a couple that can utilize their 2 CGT allowances. When people react and they sell their properties, and let's think of an example here. Let's imagine that a couple sell 4 properties at March. Now, they could have waited just 1 month to get 2 more CGT annual allowances, but they kind of went full pelt to sell them in March. And that's so unfortunate because they could have just waited those 30 days and moved it from March to April to get those 2 CGT allowances. That's another reason why people pay too much CGT. Okay, the final reason why people pay too much CGT is they forget their losses. That's right, people forget their previous year CGT losses. And indeed, they may have properties that have got negative equity, and if they sell those at the same time as a property making a profit, they could reduce their CGT allowance. So what I'm going to describe to you here is where someone has forgotten that they have got £50,000 CGT losses to bring forward from their previous years. Does this happen? You bet it does. We have lots of clients that completely forget that they've got losses on their property income, they've got losses on the mortgage interest because of Section 24 to carry forward, they forget they've got CGT losses. Yes, they forget. And unless the accountant is savvy enough to go back to the previous tax return and say, ho, 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 hold on a minute, you've got some losses here which you need to bring forward, those losses could be easily forgotten about, and you'll pay more tax, not just on CGT here, but we talk about income tax as well. So make sure, as a tip, to check your previous year's tax returns and that you have put in your CGT losses, your income tax losses in your new tax return. That aside, let's imagine that you've got £50,000 worth of CGT losses and you've got this amount of profit of £70,000. Well, now you've only got a CGT of £20,000. Well, if you've got a property as well that you're looking to sell in the future, but you're not quite sure, but it's got negative equity and it could make a loss because the property's gone down in value, then ultimately you might want to have that loss-making property disposal to offset against the £20,000 that you're going to gain on the other one. Which ultimately, if that property is going to have a CGT loss of £10,000, in addition to the £50,000 worth of CGT losses brought forward, that means you've only got £10,000 profit on that property sale. Which means it should be below your annual CGT allowance, which means you should have no CGT to pay at all. Alright guys, so has that been useful, and can you see some of those mistakes that you may have made in the past? And if so, please feel free to drop a line below this video, because I want to know if you have had these mistakes, could there have been something we could do even in the future to amend that situation? Don't forget, you can open up previous year's tax returns to make some amendments. So if you feel that some of these things that you've picked up you have made, then we may be able to do something about it and claim back some of those overpaid taxes. But don't forget to make sure that you press the subscribe channel and the bell as well so that you can be notified every time we release a video. The final thing is, watch this video all about CGT and how to mitigate it. I believe firmly, I'll repeat it, that CGT is optional. Oh, lastly, I forgot. Every Monday at 7 p.m, I do an open live session on YouTube. That's right. On 7 p.m. on Mondays, I do a session. So make sure that you're there as well to ask your property investment questions and your property tax questions, and I will answer them in that session.